Welcome to Retirementals, a podcast that dives headfirst into the issues facing the financial sector at the intersection of investment, technology and financial advice. Hosted by Abraham Oksanya, you can expect raw honesty, critical analysis and energetic interviews. Here is your host, Abraham Oksanya.
Welcome, I'm Peter Ellis, Director of Secure Lifetime Income at Just, and today I'm with Abraham Oksanya, CEO of Timeline. Welcome, Abraham. How are you?
I'm very well, Peter.
Good. Now, Abraham is well known for having lots of good opinions on many things.
Some bad ones.
Some good, yeah. And it's perhaps a construction of investment portfolios that's one of your key talking points, Abraham. And that might make it interesting why you're talking to us here at Just, who are an insurance company. What brings you along?
Well, we've been doing some research about how annuities fit into the retirement plan and thinking about it as an asset class. And yeah, we want to explore that a little bit more.
Yeah. And it's interesting because we have worked together and we've done some work with your integration team, and we've managed to put Secure Lifetime Income into a version of the Timeline app. And I think that's proving to deliver some very interesting results.
That's correct, yes. I think if you think that annuities and investment portfolios generally don't mix when people think about retirement income planning, but as the research shows, there's actually, a lot of strengths and benefit if you can blend them together somehow to deliver better income for clients in retirement.
And probably one of the things that we've found out the most interesting, we're obviously very keen on secure income here at Just, but one of the important things we found is actually it helps to serve and deliver better portfolio outcomes, bigger inheritable values for customers. And all of that is a bit of a surprise.
Indeed, yes. But the numbers back it up. Yeah. So, hopefully we'll get into a bit of that.
Yeah. And I think at the moment with the cost of living crisis, investment markets showing a bit of turmoil, searching out for alternative assets. It's interesting, isn't it, that you mentioned perhaps insurance products, annuities not necessarily fitting with investments, but in the search for alternatives in the market that many people are doing, perhaps there's one that's always been right under our noses, the humble annuity.
Yeah, I like that phrase, humble annuity. I think the way there is a lot of academic research that supports the role of annuities in a retirement portfolio. And so, and if you think about this, I call this, a formula for sucking your retirement egg because it's so simple. If you think of an annuity as bond returns plus or minus mortality credits. So if you think about it that way, actually, there's a whole body of research and evidence and academic paper, a lot of it written in the US that actually supports the role of annuities in a retirement portfolio. So yeah, maybe it's been hiding under our noses
all along. Yeah. So about 4 years ago, we started our work to put the product together to enable effectively a special version of an annuity to be put on platform, and that then the next stage of that is to put it into a portfolio. Now that again it feels a bit like oil and water. The two don't really mix because we come from different heritages, if you like. But actually, our research and our modelling has proved it's a real good mix. And the fact that when we work with your team, that the two have been proven through your real deep analytics and the way your modelling works. Has been quite a relief, let's say, because we wanted to make sure it wasn't just what we thought, but third parties would endorse it.
Yeah, so I'm keen to talk a little bit about the journey, to you creating the product or reinventing annuities, let's put it that way. And then I can talk about the research that we've done to support it. So do you want to shed a bit of light on what you've actually done in terms of the product innovation side of things?
So we actually did, is necessary in our world, is to do a lot of research, what the customers want. And post 14, people fell out with annuities, didn't feel he needed them because investments were doing very nicely too. And I've benefited myself, so I know that's the case. But there is a role, we believe, we always thought, to use an annuity, a small part of the portfolio, to build a better outcome. And as you alluded to earlier, seeking to replace some or even all of the bond component of the portfolio and build that out. And that took us to a place, well, how do we construct a product that could be delivered digitally, can be put on platform, can be bought and sold, but equally takes away some of the usual ones we hear from customers that they don't want to see, because if I die tomorrow, the insurance company will keep my money. That's the general view of an annuity. So we built in features to the product that made sure that wasn't going to happen. So we've got a product which does what an annuity does. It pays income for life, but in response to that customer research and demand was build a product that's got a good benefit on early death and allows a customer actually to cash the product in, so it can sit inside a portfolio just like other assets in there.
That's interesting. The unique thing for me in this equation is you've taken an annuity and put it inside a SIP wrapper, right? And these are, and that means that you can think about it as an asset class, which is completely different from the way that we've previously thought about annuities. When people want to buy an annuity, even if you have a SIP portfolio, you go off and you annuitize part of the portfolio, and then you keep the rest. If you want to keep some of the portfolio, then you keep the rest of the portfolio as a separate entity. The two things are always done, in the past separately. So I think the innovation here, to my mind, is that you brought those two things together so that the annuity can sit within the SIP wrapper.
That's right. And the way we think of that is done at a time to suit you, the individual. That's not at a certain point in time or at a certain age, because we'll all have different retirements. And what would work for me might not work for you, might not work for the next person. So what we've made it's a choice to purchase guaranteed income. We think it's it's believed to be a much more attractive choice now, because right now we're seeing income rates of 7.5%. And as an asset of a portfolio that could generate for life 7.5% income, that's got to have some benefits.
And I think that this work that you've done, essentially transforming an annuity from a product into an asset class, is what opened the door for the research that we've done.
Okay.
So what we did with the modeling is to say, well, imagine your traditional 60-40 portfolios, right? So you have 60% of the portfolios in equity and 60% of 40% of the portfolio in bonds.
Yeah.
If you then think of an annuity as an asset class, and you think of annuities as bond plus or minus mortality credit.
Yeah.
So if you substitute half of the bond component of your portfolio with an annuity, so then you end up with, let's call it a 60-20-20. So 60% in equities, 20% in bonds, and the other 20% in annuities. And that's what we did. Then we modeled this, and we used, the traditional, approach that we do with Timeline, 120 years of capital market data. And we modeled the scenarios. And then we looked at the success rate. I was surprised by this. I shouldn't be. We'll come back to the academic foundation for this, because it's strong.
We did similar modeling, but we aren't as maybe doing it as intricately as you are. But our modeling was telling us that. But what we hadn't got access to was the back testing, because we don't hold that sort of data. But it's great to see that what we were seeing in our initial modelling has been borne out by what you guys have done. So that's really...
I mean, as I said, the academic underpinning is always been there, right? You know, so in probably 2002, a long time ago, right? So this is 20 years ago, a guy by the name of John Amrix, who, interestingly, worked for Vanguard at the time, so this is in the US, wrote a paper about, you know, including annuity in a traditional in a traditional 60-40 portfolio, and he was the first person that I know who put the idea across to think about annuities, you know, as an asset class rather than a separate product, and I think the key thing is that traditionally, when people, let's say you have a portfolio of 100,000, right? And you wanted to annuitize a proportion of that portfolio. Let's say you want to annuitize £20,000 of that portfolio. What people tend to do, or what people did, that was the only option available, is to take £20,000 from your portfolio, annuitize it, right? And then you have £80,000 left. Then you want to invest in a 60-40 portfolio, right? So because you're a balanced investor, right? So then you invest in a 60-40 portfolio. If you look at the overall as a proportion of your 100,000, you don't have a 60-40 portfolio. You end up with something like 52-48, maybe, right? And of course, by taking equity risk off the table in this equation, you end up with slightly worse outcome than you would have done, right? If you just held the 60-40. The genius in what you guys have done is now I don't have to think about the annuity as a completely separate product. I can still keep my £100,000 portfolio. I can think of my overall portfolio as a 60-40 portfolio, and then I can annuitize, you know, 20% of that portfolio. So I have 20% in the SLI, 20% in bond, and I keep my equity allocation at 60%.
I knew I like that.
So that's the
magic.
That's the magic.
There you go. I like it. Yeah. Sometimes we were looking at it internally instead of just for a number of years, not really recognizing the sort of usability of it. It was let's build the components and then bringing it out into the wide world, let's call it. It's been really interesting.
Yeah, no, I think that there's two innovations that's happened. One is the product innovation in terms of what you've done. The other is the modeling and visualization work that we've done. So.
And I've always thought that technology should be an enabler to some of this stuff, and you've got some leading edge tech, and working with your guys has been really interesting, shown us a few things. It's been really good, thank you. With your technology, the interesting part is that it actually enables you to model with and without the SLI, the annuity, to demonstrate side by side the benefits of holding one or not, as the case may be, because for different scenarios where equities may perform really, really well, then maybe the benefits are not as good. Or if a customer's much more heading towards the probability theory, that's in line with his risk tolerance. You see how those are, as we bring those out, the ability to personalize this and say for you it works and maybe for you it doesn't. That's
a very important point. So a couple of things to draw out. So if we go back to that 60-40 portfolio as the starting point, right? The key thing in this equation is that you need to leave the equity content of the portfolio untouched at that level, at 60% of the overall portfolio. And so the allocation to an annuity or to an SLI is coming from the bond component of the portfolio. So that's key. You are absolutely right that you can model this on an individual level for for the client in front of you. And what you would tend to find is that, especially for the clients who are on the sort of lower end of the risk band, clients say who maybe their tolerance is a 40-60 portfolio,
Yes,
or a 50-50 portfolio, God forbid a lower one. You find that actually throwing SLI into that equation seems to actually help a lot, improves the sustainability of the portfolio and the longevity of the portfolio, particularly in the worst case scenarios. As you go up the risks scale, 80-20, 90-10, you will struggle, because at that point you don't want SLI to replace the equity element of the portfolio. So the beauty of this is that for the individual clients in front of you, you can model the traditional 60-40 and a 60-40 with SLI included, and different, varieties.
Any chance of putting more equity into the portfolio?
This is interesting. One way I thought of SLI is a way to help people eat their vegetables, right? So by that I mean, the key, the fundamental thing is that in retirement, many of us need risk assets to meet our income requirement. People are often quite apprehensive about holding, high level of equities in their portfolio for whatever reason. So you're right that by annuitizing 20% of your portfolio, for instance, we can get to a point where actually, you dampen the volatility in the portfolio, and then you end up with a 70-30 as opposed to a 60-40. Again, this is thinking about the whole of the portfolio, including the equities, the bond, and the annuities in this equation. So you're right. I wouldn't overdo it, though.
No.
So I think especially for clients in the lower end of the risk profile, I will bring, you can use SLI to bring them up to get, from 40 to 60% equity, for instance, or from 60, maybe to 70, for instance. There is something there.
What we've always been in our marketing of the products we've been writing for many years is that, as you say, that certainty of income. And in our world, that's a big push of the annuity, of the SLI product. In the investment world, I suppose the comparator is a volatility of income, and what the impact of taking an income on a volatile capital value. And the dampening of the volatility is something I think is perhaps under recognized here, because it is volatility that hurts as you go through retirement. I would know, because I'm nearly there. But as we get towards this, if we can dampen volatility of the income and the impact of the income being taken, I think that has real good potential for improving customer outcomes in a world where customer duty is upon us. Understanding what a customer needs, what would be viewed to them as, if you like, harm, with a small h. Doing anything we can to remove risk of exhaustion of fund is got to be really helpful, and with a solution that combines and blends the benefits of the probability theory and the safety first theory, it looks like we might be onto something really interesting.
Yeah, I mean, depending on who you speak to, some advisors might say, volatility of the portfolio isn't something that the client should worry about, and that they provide coaching and hand-holding to help the client through that journey. In reality, volatility is something that the end client has to contend with, and more importantly, volatility of income has a far more impact on the client rather than just volatility of the portfolio, because it does have an impact on their bread and butter, how much they can spend. So having SLI in that equation as a partial substitute for bonds can can dampen that volatility and as we say, improve sustainability of the income.
Yeah, and interestingly, again, we've looked at what's happened this year with our various hats on inside of Just, and obviously many people have suffered portfolio downturns.
Yes.
So the asset values have fallen. 15-20% is not unknown. And interestingly, that the increase in the rate of income you can get from SLI from annuity has gone up by more than that.
Right.
It's up by somewhere 30-40%. Yeah. So actual buying power of portfolios, looking at it down a different lens, has been increased through this period, which is a bit yin and yang, as we said earlier. It's a bit of a counterintuitive view.
Well, again, I'm going to bring my formula for sucking eggs or sucking your nest eggs into this. If, let's say, the portfolio is declined by, 15%, as long as you leave the equity element of the portfolio alone, we expect that will recover. That's what data tells us over the last 120 years of capital market data. That the equity element of the portfolio will recover. Now, comes back to the bond element, exactly the point you make, that the decline in the bond component of the portfolio is compensated for by the improvement that you've seen in the annuity rate. Right. So as far as that's concerned, the point is it does more than pays for it.
Yeah.
For the decline.
So all is not woe, all is not lost for those customers who've seen an asset value drop, that they could, with the right, I suppose, approach, actually rescue that situation or recover that situation somewhat quicker than maybe they'd thought, and a little bit with more certainty.
That's correct, yeah.
Oh, that's interesting. Interesting how we look at it down one lens and you look down another, and again, they seem to complement each other, seem to work together. I think that's really, really important. So, have we got an alternative here, an alternative asset class for advisors to use? Can it be thought of in that way? Because we hear of advisors looking for new and alternative classes. We've looked at PE, looking at property, all sorts of infrastructure-based investments. Does this rank with those?
I have to be honest with you, Peter. I just don't like the phrase alternatives. Okay. Because you never know what people are referring to, okay. Right? So what I can tell you is that when we looked at, again, I always put the weight of historical data above everything else, okay. Right? And when we looked at, the impact of including properties in the portfolio, for instance, or even things like commodities, they don't really improve the sustainability of the portfolio, okay. Right? So I'm hesitant to lump, SLI or annuities in that camp. So that's the first thing. The second thing is then when people talk about infrastructure, or what else, private equity, what else do people put in this alternative camp? We don't have the data to test it. Yeah. I haven't tested any of these things. If anyone has 120 years data of how infrastructure funds performed or how private equities funds performed, I'll be interested to have a look. Okay. My sense, so until I have the data, I don't really like to include these things in the portfolio unless I have a strong basis for it. Yeah. Now, the distinction. And why I wouldn't put SLI in the camp is A, you have data to model to model these things. B, the fact that actually I think of annuity as very, very close to bonds.
Yeah.
You know, I think of annuity as, you know, bond returns plus or minus mortality credit, and it's a product that it's been around for as long as retirement. So I always feel that it falls in a category of its own. I'm far more comfortable with equity, bonds, annuities, all these other things.
So we've got equity, we've got fixed income, and we've got guaranteed income as an asset class, rather than going a different way.
Yeah. I mean, property is an asset class.
Yes, yeah.
Commodities are asset classes, right?
Yeah.
My point about those asset classes specifically is that they don't, in the numbers that we've run, in modeling that we've done, they don't improve the sustainability of retirement income.
Let's see how that plays
And then,
out.
of course, you have fundamental issues with them. Property, for instance, in
Liquidity,
the UK, we've had liquidity issues. There's been, I like to say, a run on property funds in 6 out of the last 5 financial crises that we've had.
Yeah. So I suppose as advisors come to consider the asset classes that they're going to use in building retirement portfolios, our hope is that using your modelling and your the Timeline app, is that they're able to see the benefits, and we're looking then for them to at least open their minds a little bit to think about, without having to do the yin and the yang, as the available asset classes that they can use in the modelling, to at least consider some SLI within a retirement portfolio, given the benefits that we've mentioned. I think we found that when we looked through the range of tools available to advisors, it wasn't really possible to think about adding a bit of an annuity. It didn't feel that that was what the modelling tools were encouraging advisors to do. So we'll need to work hard to help demonstrate the benefits to advisors. And we're asking advisors, I suppose, to use the tools and then just take a little minute to think about, well, what would happen if I used half of my fixed income and allocated that to the SLI product, and then just sit back and see the answers and see the outcome benefits to customers.
Yeah, I mean, that's the beauty of technology, that the advisor can, based on the client sitting in front of them, have a conversation, of course, and then, model a portfolio with SLI, one without, compare and contrast. And a key point that you made earlier on is that it's dependent on the client sitting in front of you.
Yeah.
I mean, how do you imagine, what sort of questions would you as an advisor be asking clients, to give consideration to SLI?
Again, it's the importance of some guarantee in today's turbulent times, having make sure that income is there, would be paid. But importantly, is flexibility and certainty, which is more important, are both important to a client. And in the past, I think it's like which overrides one, so it became one or the other. And then have an understanding that both can be accommodated in the proportion to which it applies to the customer. So it might be that he wants majority probability based, but he wants some certainty of the guarantee, where it might be the other way around for other customers. And it's not a matter of it's A or B, and you have to choose whether one slightly wins the argument or the other wins the argument. But actually you can have both, and it's in proportion to your particular needs, desires and circumstances as you go forward.
Would you say that as we see more and more people coming up to retirement without DB pension?
It's interesting, isn't it? Because there'll be customers now who had DB pension who chose and found it attractive to move out of that, and might now be looking in the rearview mirror. Importantly, they have a choice now. They could actually re-secure some of those guarantees. Not necessarily all. I'm not saying it was a poor or bad decision to transfer out of their DB scheme, but as situations change, it could be that there was a little bit of harking back, and would I have liked to have kept some of that guarantee? This solution allows you, within the SIP that you've purchased, to buy some guarantees. And I think that might be attractive to people. But then answering your actual question, which was for those that don't have guarantees from their DB pension, certainly an element of certainty to know that the lights are kept on, and I appreciate that's a topical issue right now, is really important. And the interesting thing we've found with some of the people who've bought the SLI product is they're actually thinking about buying a bit more.
Right.
So having bought some, and as you said earlier, the portfolio will rebalance, and they might find that they've got a little bit more balance in equity now, and that's done quite nicely. So is it worth now just revisiting the portfolio and saying, should I take more risk off the table by using some more of the bonds that were left to buy a little bit more of the SLI? That's a real beauty of the product, that you can buy more and more.
So you can buy in chunks.
And buy in tranches over time and progressively maybe de-risk a portfolio, or as you said earlier, take the benefits of the equity assets appreciating that bit more.
Is there a minimum you can buy?
There's only 5,000. You can buy it with 5,000. It's a digital asset, so there's none of the annuity thinking on reams of paper. It's all held on platform.
That's interesting. So I can't imagine how hard this is to get on platforms. Let's talk a little bit about that.
Well, the challenge is firstly to make advisors aware of that it exists, and then to see the benefits of it. And yeah, I would argue that for a number of years, the probability-based theorists have been winning the game because they didn't see the need for the guarantees. I think the last 12 months has perhaps rebalanced things a little bit. Certainly the income rates available with the product having risen substantially bring just the emotional decision a bit easier if you can get 7% from an asset. That looks quite nice. So getting it onto platform is all about advisors wanting it on platform. The platforms will all tell us, when the advisors tell us they want it, we'll put it on there. So bring it on.
So today it's available on
Novia and 7IM, working with a few more companies to bring it to market.
All right, so advisors need to be speaking to their platforms.
Absolutely, and if they see it, if they've used your technology, they've understood and seen and demonstrated the benefits, that's when I think we'll get more people wanting it and maybe making those phone calls. Right, Abraham, we opened this up saying you had some controversial views. Do you feel this has been your norm, your usual somewhat controversial self, or have you found this sort of goes with the flow a little bit?
Well, depending on who the audience, I don't feel that this is controversial in any way. As you know, as I said to you, I wrote a paper about this in 2018 on this idea of bringing these two conflicting ideas together, and I think that people will see the sense.
They'll see the light, I'd say. Thank you very much for coming in today. It's been a really interesting conversation. I think we've found some commonality despite coming at this from perhaps two different angles. I think it'd be really interesting to see how working together we can get more advisors to perhaps see the light. Thank you very much.
Peter.
Cheers.
I'll be remiss if I don't thank my incredible team who worked very hard to put this program together. Thank you very much, guys. I'd like to thank our sponsors, Timeline Retirement Planning Software and PyTech, low-cost flat fee model portfolio manager. And to you, our listeners, thank you for your time. I hope you've had as much fun listening to the program as we have making it. You can find more about the show at retirementals.co.uk, and you can follow me on Twitter. My handle is Abraham on Money. Until next time, thank you and goodbye.